Hello, everyone. Welcome to today's webinar, Leading the Charge in Sustainable Finance. I'm Joel Makower, Chairman and Co-founder of GreenBiz Group, your moderator for today. Before we begin, a couple housekeeping details. First, this webinar is being recorded and the recording will be available to all registrants a little bit later on. Second, we encourage you to ask questions, which you can do via the questions tab in the bottom right of your screen. We'll be taking those later on in the hour, but you can type them in at any time. The topic today is sustainable cash management. Now, I'm guessing you all know a great deal about cash management, but what exactly is sustainable cash management? And how does it work? And what are the opportunities and the risks? And how does it align with sustainable impact and ESG investing or any other approach that aligns financial returns with social and environmental considerations? That's the topic. Those are some of the questions. And joining me today are two innovators in the field of financial management. Gloria Nealand is CEO and founder of TriLink Global and a veteran of the international asset management industry. She brings more than 30 years of experience in executive management of multi-billion-dollar financial institutions, as well as deep expertise in the creation, sales, and distribution of investment products. And joining her today is Catherine Berman, CEO of C-Note, an innovative financial platform that allows anyone to make money investing in causes and communities they care about. Kat has been widely recognized for her work, including as a Worthy 100 entrepreneur, Real Leaders 100 Women Impact Leaders You Should Know, and in 2022, way long time ago, was named Entrepreneur Magazine's Top 100 Women of Influence. Welcome to you both. Gloria, let's start with you. You operate in the private credit market. Talk a little bit about why that's becoming such a big opportunity. What created the opportunity and why the growing popularity?
Yeah, I would love to. It has been phenomenal, actually. This slide just gives you a little indication of how much private credit has grown. Investors actually now have allocated $1.7 trillion to this asset class. And honestly, it was only about 5 years ago that it actually even got its own designation as an asset class. And you can see that money has poured into the asset class. The little bottom dotted line on the left slide shows how much dry powder there is out there. So the investment funds, whatever, that have attracted all this money, at least in the US, have struggled a little bit to get it invested. But we've seen a huge change in that recently. As banks, and this is what's driving the change, banks actually have really pulled back from lending. And, we saw it right after the financial crisis. Banks pulled out of lots of markets. They also basically got out of certain kinds of lending practices. And what that's done is driven a lot of people towards private alternative investing, particularly in private credit. And the other thing that's really driving the growth in the asset class is this asset class over the last decade, particularly direct lending, has generated higher returns than most other comparable asset classes. You're getting a 2 to 4%, spread above even syndicated leverage loans, which have been a huge investment for a long time for institutional investors. And the investees, the borrower companies, actually have wanted to go with private lenders because of their agility, their ability to execute. It's tough dealing with banks. I mean, I think we all know that from a lending perspective, it's been hard. And then also, private credit investments typically are less risky than private equity. They have more predictable returns, and it's typically non-correlated to public securities. So it's been, as you can see, there's been a big growth in the asset class, but I also think for really good reasons.
Well, we'll talk a little bit about how this fits into an investment strategy. I mean, you've got fixed income. How is this different?
Yeah, so public security, all public securities, right, are subject to market trends, and I'm going to say the whims of investors. And so private credit, while it also does generate a fixed coupon typically, private credit is very non-correlated. I wish I actually would. I almost put that slide in to show the non-correlation between private credit and public fixed income investments, because it is there is a huge non-correlation between those two. It also offers typically higher coupons than bonds, and one of the ways that investors access fixed income, right, is through bond funds. And one of the issues with bond funds is, as people sell out, and you have to, you as an investor have to then, sell off securities. You might be selling them at a bad time. You're not necessarily holding them to maturity. Whereas in private credit funds, typically there isn't a market for those. There's not like a secondary. So you usually hold them to maturity, which means you're going to get a lot more stable value in that sector of your portfolio. I wouldn't say it should not replace a fixed income allocation, but it certainly should be a part of it. I mean, right now it could replace a high yield bond allocation because you're going to get better returns on private credit. Yeah. But you'd still have other fixed income type of investments, including cash, right? Which is why we were so excited to do this webinar with Kat. Is C-Note has, I think, one of the most interesting, best cash products out there, particularly for all investors, but particularly for sustainable investors. And it's considered part of your fixed income allocation. People think of stocks, bonds, cash, but you actually can put the cash in your fixed income bucket because it's got great returns and operates similarly to private credit.
Yeah, well, we'll go over to C-Note and Kat in just 1 minute. But one more question for you, Gloria, is where does TriLink Global fit into all this?
So we are a global private credit manager. And one of the things I would say that's different about us, there's a couple, but one of them is, a lot of that money you saw on that chart flowing into private credit is going into, in fact, I have a slide I would like to show, it's going into the larger commercial type of companies. So if we could pull up, let me see if I can get this slide. Right here, I believe. There we go. What you can see is the average loan size for most of those funds. This is like BlackRock and all of the big names where the money's going. The average loan size for them is anywhere from 45 million up to 80 million in average loan size. Deal sizes are in the hundreds of millions. Our average loan size is $8 million. So we're actually targeting the lower middle market business owners who have no other access to capital to grow their business. And so, that's one of the things that makes us really unique. The other thing is that we are a sustainable private credit manager. So we are very picky about the companies we invest in. We want them to be sustainable, responsible companies. And we also want them to be committed to help change the world in some positive way. But we are not willing to give up investment return to do that, because most investors can't or won't give up investment return to do good, and they shouldn't have to. I mean, that's really the bottom line.
Great. Well, let's move over to Catherine Berman. Kat, Gloria kind of set you up in a nice way, but fill in the gaps a little bit for those who don't yet know C-Note.
Absolutely. And Joel, thanks for hosting this conversation. Certainly. Well, I'll start with kind of a little bit of the genesis. So my background in financial services, I was actually managing director at Charles Schwab prior to starting C-Note and venture capital prior to that. And I feel very fortunate to have been part of what I call the rise of value-based investing. So whether you call it ESG or you call it impact investing, I saw many of our largest clients have a desire to align their portfolio with their values, which I thought personally was incredibly exciting. But where I started scratching my head, Joel, was, as we started having these conversations about aligning the portfolio, recognizing that many high net worth individuals hold anywhere from 20 to 30% of their portfolio in cash. I saw that research wise, we saw that anecdotally, and yet me and many of my peers in finance had no impact option for cash. So here you have lots of dollars sitting on the table and no really impactful way to put it to work. And so I started looking around and really trying to understand, why did we leave this concept of impact out of the impact portfolio? And what I found pretty quickly in interviewing investors and interviewing institutions was there was a lot of friction. There was some really incredible institutions in community finance. And I share that I was very grateful to have friends and colleagues in the CDFI, Community Development Financial Institution community, in the Minority Deposit Institution community. And these are certified FDIC insured banks and NCUA insured credit unions that take deposits and put them to work, again, fully insured, to work for good, to work for really exciting, positive impact. And yet there was sincere friction between those investors who wanted to put their cash to work for good and those institutions that were doing the great work with your cash. And so as I started teasing out those friction points, I realized there was a massive opportunity to do two things. Number one, to unlock cash as an impact tool. And that's really what we're trying to do here at C-Note, is recognize that cash can be a transformative tool for impact and change. It can really represent our values and the values that we put forth in our portfolio, and do a heck of a lot of good. Because the reality is, if we unlocked just a percentage of cash in the United States, we would see dramatic change in terms of access to capital for low-income communities. And I'm excited to say dramatic change as it relates to carbon reduction activities in combating climate change. And so that's really what the mission is of C-Note, is use cash for good, unlock the potential of cash, and in a way that makes it easy. I mean, I think Gloria did a beautiful job talking about how important it is for investors to have their returns and portfolio goals met, how important it is to make it easy, which I know that TriLink does. Similarly, at C-Note, that's what we're trying to do, is really create that infrastructure and that ease of use. So whether you're a wealth advisor or an individual investor, you can now see cash as an opportunity to not just make those portfolio goals, not just do opportunistic investments or manage it as such. It can really be a tool to complement your impact portfolio.
Yeah. And to be clear, C-Note's not making these investments directly, right? You're a platform to talk about how the money gets from the investor to where it can do some good.
Yeah, let me pull up a quick slide that shows how it works, because it's a great point, Joel. We are not a fund. It is actually a tech solution. So the good news is what we're doing is helping you move your cash from point A from point B. So here's a great example. One of our C-Note clients is the Sierra Club. We're proud to have them and many incredible foundations and corporations and individuals as investors and depositors. And so the first thing to know is every last dollar is FDIC insured. And so when you think about impact cash as a tool for you, keep in mind there is no trade-off in terms of risk. If your dollars are sitting in a bank right now fully insured, your dollars are going to keep sitting in banks fully insured. The difference here is where they sleep at night. Which banks are you working with? And so the way it works at C-Note, if you take a Sierra Club, let's say they decide to move $5 million of their cash into impact cash, what we're going to do is we're going to identify through our database who are those mission-driven depositories that meet Sierra Club's needs. So who are those Black-owned banks? Who are those women-led credit unions? Who are those CDFI banks, right? So we vet every single one of these depositories, not just from financial strength, but for impact, genuine impact in their community. And then we say, great, Sierra Club cares about climate. How do we make sure that if we move those $5 million into these depositories, those dollars are going to be put to use for carbon reduction and climate change activities? And so again, this is all of the vetting that we do with our platform. And then we take care of all the administration. So Sierra Club does not have to call the banks. They do not have to open up individual accounts. They do not have to do 6 KYC AMLs. We literally do all that via our platform for Sierra Club. So we take all the administrative burden from them. Then we move those dollars seamlessly from one FDIC institution into another. So there's no kind of in the air or no hitting C-Note. It literally moves into these accounts ready for prime time for the exclusive benefit of Sierra Club, already with their name. And then we take care of all the reporting. So once those deposits hit those accounts, now Sierra Club's treasurer has opportunity to see all of the financial reporting in one portal. That includes statements, that includes transaction history, and it includes impact. And that's a really important piece of this equation, Joel. You know, it's one thing for us to say, great, we can meet your return needs, your liquidity needs. But if we say we're going to meet your impact needs, we want to prove it. And so we actually provide quarterly impact reports to our depositors to say, you took these deposits and moved them back into community, and what happened? And it's pretty phenomenal to get to see the difference of what a deposit can make simply by moving it into these incredible community institutions. And so that actually is how the system works.
So, wow, that's great. So you remove the friction, basically. You mentioned Sierra Club, and I know you have some big corporates, so Netflix, MasterCard, I think PayPal, I'm sure a bunch of others. What about for individual investors? How downscalable is this? If I have $5,000 or $50,000 or whatever, $75,000, or do you need? You mentioned $5 million from Sierra Club. How small can this be?
Yeah. So the good news is we work with depositories across the country, and I will give you the fun fact, they absolutely need your deposits. So there are so many kind of variables at work right now, but I will tell you that there's an estimated deficit in deposits of over $3 trillion in 2024 alone. And so your deposits moving into community has never been more important. And so whether you're willing to bring $5,000 or $5 million, I will tell you those deposits are needed, and we have a home for them.
So is there a minimum, or is it 5,000? Just how does one play? If one wanted to dip one's toe in the water, what would that look like?
Certainly. Usually 250K is usually where we start with investors or with institutions in order to have the best use of the platform. But if you have south of that, let's say you want to try it with 10,000, we absolutely have direct bank connections that will say, great, we found one in your neighborhood and let's make that direct connection. Yeah. So 5,000 or 5 million, either way, we're going to get you matched up with the right mission-driven depository.
Yeah. So, Gloria, how do these two pieces fit together? How does C-Note and TriLink or Global, or more specifically, the different cash management techniques that you both use, are they mutually exclusive? Can they work together? Talk a little bit about that.
Sure. They do work together. So we are really a private credit manager. So we are filling an fixed income allocation for an investor. The C-Note Impact Cash product is filling a different need because it's really a cash management tool, and all investors need both. And so we're actually quite complementary in that we both see the world the same way. We both believe that investing is the way to make the biggest difference in the world. You heard Kat say, like, if we could harness the power of all of this capital, just from even if all we did was do it in the cash management space, we would make a huge difference. Or if all we did was, hold all of our borrower companies accountable that we lend to, we would make a huge difference in the world. So investing is absolutely the way to solve some of these big world challenges that we have.
So both C-Note and TriLink have been innovators in their respective areas. I'm curious, what are some of the challenges and potential solutions you've both seen as you try to push the boundaries, I guess, of sustainable investing? Kat, I'll start with you.
Sure. I would say one of the biggest challenges are the myths in the market. As Gloria referenced, I think when we all started this journey years ago, there was a natural assumption that you'd have to make trade-offs, right? You're going to get some very low return or have some very high risk investment if you want to actually align your portfolio with your values. That simply isn't the case today. And I think investors and advisors understand that there are some really great options out there to help your client meet their portfolio goals in whatever way that works, while complementing, right, their impact goals. And so I think really combating those myths that you have to do a massive return trade-off, or it's going to be illiquid, Or, it's not going to be easy. I think one of the things we strive to do at C Note is make it incredibly easy for people to say yes. And so how do we plug into your existing, right, portfolio management system? How do we give you access to that data? How do we give you the impact stories so that you can share those with your clients so that you look really great and so that your client leaves really inspired and really connected to you? And so I think we've come a long way in impact investing. And so for those folks who are still thinking it's hard or they have to do some massive trade-off, I think combating those myths is one of the biggest challenges we still face.
Yeah. Gloria?
Yeah, I would say that's exactly right. When we launched TriLink, and our first fund was a public fund, so we were selling through financial advisors to individual investors primarily. And I was so excited because I thought, wow, this is such a cool thing that you can have an investment that also creates an impact. And it's such a great investment story itself. So just on the investment side, it's a great story. And then you get this, this impact. And so I was really excited to talk about it. And the very first roadshow meeting we did with a bunch of financial advisors, I got up first and talked about, impact investing and how exciting it was and how it was going to be the best thing for their investors. And then Paul got up, our CIO, and talked about the investment strategy. And literally by the time Paul was up there, you could see advisors' eyes rolling in the back of their head, like they had no idea what I was talking about. And so by the time Paul got up to talk, they weren't listening. And so for the next day, literally we said, okay, let's switch the order. Let's have Paul talk about this great investment strategy. And then I will talk about impact as a bonus. And that is ultimately how we were able to be successful, is to reframe, what it was, which now looking at it, it makes total sense because it was such a new thing that people didn't know, how to think about it. They know how to think about investments. They know, where it fits, what it's supposed to do, how to measure it. But when you add this other component, it made it more challenging. And so I would say, we still do that. We still lead with the finance side of it and the investing side of it, and then talk about the cool impact. But I think we've come a long way in terms of investor education about how important it is. And, I would say the industry, generally speaking, struggles with identity. I don't know how else to say it because, there's the ESG term still, there's impact investing, sustainable finance. There's still a lot of terms that get thrown around. And, I always said from the beginning, look, I want to help support the industry and I don't really care what we call it. But we all need to be on the same page about what it is because it has such potential to bring about transformative change. And, I like we do call ourselves impact investors, but I do like the idea of sustainable finance because it's more encompassing. And I think it's more comfortable for people. And, more recently, terminology is another thing that's gotten in the way because ESG has become so politicized here that, which is crazy to me because I go, well, who shouldn't want their company to be responsible? But it did get very political. And so we've had to, sort of back away from some of that messaging. And, that it's just what Kat said. That's been our biggest challenge is people's perceptions, right?
Yeah. What do we call this and how do we break through? And, at some point, shouldn't sustainable investing just be called investing? But I guess I was going to ask you about, all this political pushback, the anti-woke and the, ESG and greenwashing and all of that. And Kat, I'll start with you on this one. How is that affected? And how do you work around that? Has it dampened enthusiasm for the kinds of things that C Note and TriLink do? How is that? Talk a little bit about how you feel in this moment and how you're working through that.
Yeah, well, I'll start on a personal note. It has never been more important. So to state the obvious, we're an election year. We face a very polarized country. And so now more than ever is the time for us to vote, right? To vote our values to invest in our values. And so I would say it is a really important time for folks to lean in every way they can. And I think, just my conversations with individual advisors is this is a time to get closer to your clients. This is a time of great concern for a lot of folks. So it is a time that you can really deepen your relationships with their clients. And this is certainly one tool. And then in answer to your question, I think one of the things I think we've done at C-Note that I'm really proud of is really host across Impact Cash a variety of things. And so when folks come to us and want to unlock their cash for good, we say, what matters to you? Because for example, what investing in women could be different for you, for Gloria, for me. It could be investing in women-led banks. It could be investing in women of color entrepreneurs. It can invest in women financial literacy. And so the beauty is we've created a really robust database to know exactly how these banks and credit unions are investing in women, exactly how these banks and credit unions are putting money to work for climate change, exactly how these banks and credit unions are advancing racial justice. And because we have that really sophisticated data, when we put deposits to work, we can be very specific and we can track it and prove it. And so I think in that way, we don't have to show up and say, why don't you care about racial justice, right? Or you should really care about climate change. We can really invite the conversation of what's important to you, right? And for an investor, what's important for your client? And then really mirror that in the way that we deploy that cash. So that is one way that we can lean in on using cash as a tool without, again, having to play the acronym game, or frankly, stepping into the political, what do you want to call it? Or what acronym do we not want to bring up on this call?
Yeah. Gloria, any further thoughts about the political aspects of all this?
We avoid that. So, because to me, it shouldn't even be a political issue. I do realize there are reasons that there's governments get involved, absolutely, but I don't think it should be such a political issue. It's just frustrating that it is because, like we said before, investing is a tool for everybody, and investing is a really good way to hold companies accountable to good behavior, calling it whatever you want. And so it's frustrating to me that it's, this whole industry gets sucked into that, because it's not a political issue. It really is about making the world better and holding companies more accountable to help us make it better. And so we literally do try to avoid the whole political discussion because, and the way to do it is exactly what Kat said, which is when we engage with advisors, we talk about their clients and what are important to them. And I think that's a really important role that we can all play, is helping advisors get closer to their clients. And even on the institutional side, helping them get clear about what their mandate is and why they do need to do what they need to do for their mandate. So
Gloria, then I'm going to turn to you on this one, Kat. Tell us a story about, probably an anonymized client, or as specific as you can, in terms of how you deployed the cash in a way that probably might have been unexpected or maybe unknown to a typical investor, and how you managed to make a difference. The more real life, the better.
Yep. I'm going to give two actually very brief examples, but because they're a little bit different, and we do both. That's the reason I wanted to talk about both. So we do invest in companies where their business model itself is that can make a difference. So we have a waste to fuels processor in Mexico that literally takes trash from the dump and turns it into low carbon jet fuel that then it sells to the airlines. And so it's that business itself, right, is all about improving the environment, and it's getting rid of big trash dumps, and it is helping airlines meet this lower emission type of jet fuel. And so that is where we invest in a company that's its business model is impactful. But we also have another a company in a small business in Uganda, where the two brothers that started it basically saw a need for the farmers, all these smallholder farmers in this particular region who have lots of land, but were only growing enough grain for subsistence living because they didn't have the education, the resources, the networks to know how to actually turn that into something more profitable and solve a huge food security problem in Uganda. So they started their business by training the farmers, getting contracts for them, creating opportunities, teaching them best practices in farming. And then they eventually also bought their own land so that they could help meet this food security problem in Uganda. But they continue to do the training. They continue to, bring a lot of resources to that area. But their business is they're grain farmers. And so you can see that the business itself isn't necessarily the impact. It's how they go about running their business and, their commitment to making a difference. And obviously during COVID, they were really impacted because, here, yes, we got impacted for a short while, but if you think about it, in 2021, by 2021, it really became a supply chain problem because the whole supply chain was broken. And so these guys who now rely on exporting their goods had a big problem, right? And so if they would have been financed by a traditional bank, the bank would have just foreclosed, started, cashing out assets, and they would be out of business. And I would say this is one thing where we are different. Our assessment first is, can they make it through this, right? Is this really a liquidity problem or is it a solvency problem? Once we've determined that it's just a liquidity problem, then we will work with them, restructure, help them get back on track. And they are, in fact, now back on track. Revenue's growing, EBITDA is growing, and they're beginning to service their loan again. And so it has, in the short run, it does affect investor returns, but on an unrealized basis. So once they start getting back on track fully, then everything will get marked back up and it won't affect investor returns. And so it is a little bit different in terms of how we approach our investments. Anyway, and these are just a great company, great people.
Those are both great stories, but I want to push back a little bit because both of those, the sustainable aviation fuel, which is partly regulated market, partly there's some big players, the oil majors, and then a bunch of very well established like Neste companies that have entered the market in a big way, and Uganda farming. I mean, those are both sound risky. Those do not sound like FDIC insured slam dunk.
Yeah, but we are. That's not us. We aren't. You're mixing cash management with.
Okay, so forget the FDIC part, but those have a reasonable reasonably high, I would say, risk profile. No. I know you might think that, but it all depends on how you structure the loans and what you take as collateral. So in all of our cases, we're only lending against cash flow, so they have to have enough cash flow to be able to service the loan. And then we also take everything they own as collateral. So we own all the assets of those companies. And if anything ever went bad, then we would just take the collateral. So we are both cash flow and asset-backed lenders, which is something you don't often see. But in this lower middle market, they don't have options. And so it's, you get better security, you get better collateral. And in fact, during the pandemic, we only had one company that we determined was not going to make it through. So we had to liquidate the company, and we recovered over 90% of our money on that loan because we had all the assets and we were selling into a down market. So we still recovered. Yeah. So Kat, tell us a C-Note story.
Yeah, absolutely. And I want to start with, I think many of the folks on the call today have probably explored different options in this space. So I really want to honor that when we talk about sustainable investing. You may have experiences with a sustainable ESG portfolio. You may have experience with green bonds. And so, I want to share a little bit about like what's different when you try to use cash for sustainable investing. I think the first thing I would highlight is it's incredibly transparent. Having tracked green bonds for years and kind of the highs and lows and friction points with green bonds, I can tell you in our talks with investors, I usually get kind of a big fat smile when I talk about this, only because transparency has been such an issue with green bonds and reporting, right, has been such an issue. And so let me share with things like climate cash, right, which is using deposits for carbon reduction activities. It's as simple as take your deposits, provide it to a bank that's going to use it for very tangible green lending programs. What do I mean by green lending programs? How about providing community solar to a low-income community, funding that project, tracking that project, delivering that community solar, tracking utility, right? How about retrofitting, right? Commercial buildings. How about more easy access, affordable access to electric vehicles and the maintenance of electric vehicles? And so I provide these very tangible examples of when you use cash for climate, I'm not talking about a project that might be built within 5 years that you might see some, carbon reduction and you may get the impact reporting. It's in fact the polar opposite. It's literally probably within the year, you're going to see, if not shorter, you're going to see the fruits of your labor, because these are individuals, these are communities, these are families who are facing dead on, right, the effects of climate change. And now they have a way out. Now they have an open door to do something, not just for them, like dramatically reducing, right, energy utility and the cost of that, but also for our environment. So let me give you, you asked me for a story, so I'm going to give you a story. So climate cash, how do your deposits go to work? Great example of Jessica and John at DC. So Jessica and John, first-time entrepreneurs, both people in environmental policy. So they had a great understanding of climate change, what we need to do to combat it. And so what they wanted to do is actually start building solar communities throughout the DC area, particularly focused on low-income communities. If the audience is familiar with Solar for All, it's a fantastic program that is effectively mobilizing over 100,000 families in low-income communities and providing them access to greater solar energy, in effect to reduce their energy bills by 50% for 15 years. So a 50% reduction in their bills for a low-income family. Amazing program, but how do you capitalize it? And so Jessica and John, like many entrepreneurs, went to a big bank to get that loan, and as you can imagine, got an absolute no. And so then they went to one of our mission-driven deposit institutions, Locus, a wonderful CDFI bank out of the DC area. And because of the Impact Cash program, because of our climate cash work, they were able to get that loan, fund the Solar for All projects that they were looking to do. And now I'm happy to say that they literally have built over 49 projects in the DC area for low-income communities. Tangible. Like I said, this didn't happen over 5 years. This didn't take some great credit report. It was literally individuals, investors, institutions said, oh, I'm going to take my deposits from here and I'm going to move them into here. And guess what? Now we have 49 different solar projects happening in low-income communities. So that's an example. We have many more that I give of your cash can make a difference. And particularly as we think about fighting climate change, every tool helps. And we just see this as one more tool in your toolkit.
Yeah, I want to ask you the same question I just asked Gloria about risk, default rates. Talk a little bit about what those are in C-Note.
Yeah. So again, when we talk about cash, the way our solution works is every last dollar is FDIC insured. And so the ways that we mitigate risks, and keep in mind, we really built this, right, with finance in mind, knowing that for most of the folks we talk to, capital preservation is number 1, 2, and 3. Do not lose this money. This is the cash. And then, of course, you want to look at things like yield. Can you get me competitive yield? Liquidity. Can you have this, meet my liquidity needs? And so with that in mind, the way we think about risk mitigation is number 1, we vet every single institution. And so no bank or credit union is accessible on our platform without being in good financial standing. And in fact, we monitor it every quarter. And so we look at both their financial strength, but also adverse media, right? So these are things that we proactively do as part of the platform. So that's first and foremost is access, to a really wonderful vetted community of depositories. And then secondly, every last dollar is FDIC insured. And so should anything go amok, again, you have full faith and credit of the US government behind your deposits. And so, as we think about, the risk spectrum, we try to really put this in the bucket that is capital preservation, that is trying to really protect those dollars and putting them to work in good use.
Yeah. So there's never been liquidity. The default rate is 0?
Correct. So we have not had one bank or one credit union go under since the onset of C-Note or C-Note Impact Cash. Correct.
Yeah. Wow. All right. We have want to make sure you're asking questions. We have a couple have come in, and we'll take some more in just a few minutes. So I can't imagine we're answering all your questions, but I want to get to one that may be on that list. I want to ask you both about both time horizons, short, medium, and long term, locking up your money, and that goes to liquidity. You talk a little bit about, Gloria. How are you making a 3 or 5 year commitment, or can you get your money out if you need it? What happens there?
Sure. We have different options. So we have literally 3 different options in our funds. So we have 2 funds that are just closed-end funds. They're illiquid for 5 years. You invest, you're getting a coupon, and then at the end of that 5 years, we start returning capital. Those are, completely illiquid. You get a little higher return for that. And then we have a fund that it has 20% liquidity per year. So it's the most liquid of ours. It's 20% at the fund level. So an individual could get all their money out if they wanted after a 1-year hold. And then we have another fund that is our public fund that has a 5% annual cap on liquidity at the fund level. But again, you could end up getting all of your money back if we didn't hit the cap. So we have different liquidity options for investors. And the only difference, the investments are very similar. And the only difference is with more liquidity, you get a slightly lower return because we have to invest shorter in the tenors of our loans. So liquidity has a trade-off, a return trade-off, which is true with any asset. So.
Kat, time horizons, liquidity.
Yeah, so the way we built this solution is to really be the connection point between all that is offered from depositories and all that investors are looking for. And so we really span durations. You can get cash as fast as overnight liquidity, or you can go up to 10 years. And so it's less about, a single, option and more about what are you looking to do with this cash, right? And if your objective or your currently holdings are overnight, great. Let's share with you what's available there. If it's longer term, you're now looking at 2-year CDs, 4-year CDs, great. Let's share with you what your options are there. I will say one of the things we typically share with investors is treat this less as more like your savings account versus your checking account, which means, if you're going to put $100,000 to work today, but you're going to take it out tomorrow, it may not be a great match for, a low income bank that really is going to put those dollars to use and recycle. But with that in mind, I will say the strength of this ecosystem is really doing a great job on asset liability matching and putting those dollars to work for as long as they have. So if you give them overnights, they're going to put them to work. If you give them 2 years, they're going to put them to work. So it's a pretty established and strong depository community.
Yeah. So what are some of the other myths and misunderstandings that you think are important to help financial professionals, investment professionals understand about all this, whether it's about your own companies or about the field in general? Gloria?
I would say for the field in general, but from looking at it specifically from a private credit perspective, I think often investors think that, you can't really have an impact, if you will, on the borrower unless you're an equity investor. And we are not an equity investor. We make loans to them. And that is a complete myth because even as a lender, you have a lot of influence over their behavior. And so it's not only what you expect them to look like, when you are doing the due diligence and making your initial loan to them, but we do our due diligence on an annual basis, and we're holding them accountable to those behaviors all along. The other really great thing about private credit over private equity, and I'm not against private equity, it's appropriate sometimes, is that when you are making a loan to especially in this lower middle market, you're leaving the ownership in the hands of that owner, that business owner, and their employees. And so when there is some liquidity event, then the wealth creation actually happens there, which is what we want, right? We want them to be able to reap the benefits of all of their hard work and labor. So that's an advantage to doing lending over equity investing. And again, particularly at this lower middle market, it's really important. So I think the misconception that as a private credit lender, you can't have an impact on these businesses, you absolutely can.
Yeah. Kat, myths and misunderstandings?
Yeah, I mean, I would really focus on the opportunity. I think sometimes as a wealth advisor, it can feel like, oh, is this one more thing I need to deal with? And yet I look at sustainable investing this year and the opportunity Gloria is talking about around private credit, or the idea we're talking about climate cash. This is an opportunity for investor engagement. BNP did a great study this year, January 2024. More than half of individual investors are planning to increase their sustainable investments within the year, like over half. And so it's not a small sample size, right? And so if we know that our clients care about this, likely care about this, have expressed they care about this, then I think this is a massive opportunity for advisors to expand the tools in their toolkit and say, are you thinking about doing something more? And here we are. It's an opportunity, obviously, for client engagement. It's an opportunity for great stories and great impact like Gloria is sharing. It's an opportunity for greater revenue, as we've seen with several of the folks that we partner with. And so I do say that I think this is a real incredible opportunity time of impact. And the last cherry on the ice cream I want to share is GGRF. The Greenhouse Gas Reduction Fund is the very large, right, multi-billion-dollar investment that the government has made to really fuel the future of climate finance. I will tell you that GGRF, the Greenhouse Gas Reduction Fund, absolutely has an impact on our work at CNOTE. We know and love a lot of the organizations that were recipients of those funds. And so they are behind the scenes creating more and more of these type of green lending products that our deposits go into. They're creating more and more of that savvy borrower. They're creating more and more of that strong, financial infrastructure. And so now is the time to leverage over $20 billion of government funding and put your dollars to work. And so whether you're thinking about doing incredible private credit with TriLink or thinking about moving cash, this is a pretty historic time to lean in, because it's not just about what your investment's going to do. The government is literally putting billions of dollars behind this ecosystem, and it'll catalyze it even more.
And how does one tap into that?
Yeah. So I would say, again, from our standpoint at CNOTE, we are already aligned with a lot of the folks behind GGRF. And so working closely together to make sure we are supporting their efforts with our deposits. As you probably read, private sector involvement was baked in as a mandate, right? Endemic to the GGRF proposal. And so how does that happen? And so again, solutions like ours at CNOTE really help a private sector player, whether, again, you're an institution, an advisor, an investor, go, oh, I want in. I know that this is the time, and I know, right, we don't have more time to lose. And so we're tapped into that. And I'm sure Gloria as well, right? And there's a lot of those folks tapped into that.
Yeah.
Yeah. Go ahead.
Go ahead, Gloria.
I just wanted to jump on something that Kat said about, financial advisors and helping them really get closer to their clients. And really, both of what we do can help them do that. And it's interesting because one of the things we found early on when we were talking to financial advisors in particular is a lot of their clients actually are business owners themselves, or were entrepreneurs or business owners. And they really do get that businesses can be huge drivers of change. And, they're in the US in particular, they are the driver of our total economy. And when an advisor starts talking to their clients about, their own company and how they made money and what's important to them, and then they can really introduce products that are tied to those same interests and values and concerns, it does help them get closer to their clients, which I think is a really important statement, for sustainable finance in general.
Yeah, love that. In the few minutes we have left, I want to ask you a couple of forward-looking questions. First of all, where's all this going? What's next for impact investing, or whatever, however we brand it? Gloria, I'll start with you.
Well, I hope it's what you said, where we're doing it so much and so well that it just becomes synonymous with investing. And I do believe that we are getting closer to getting there. It's taken a lot longer than I ever thought it would, but I do think that even in public companies now, the accountability has definitely been raised because of all of this effort around sustainable finance. And so, I think in the next 10 years, it's going to, grow even faster because people are realizing that they don't have to give up investment return to do good, and that it should be what they do and what they care about. So personally, I think, we're going to continue to see growth in the industry and get to that point where it's just the way you invest.
Yeah. Kat?
Yeah, I think there's three things on the horizon. I think one is the continued proliferation. Over 86% of millennials are interested in impact investing, not 50%, not 60%, over 86%. And so we know that both millennials and Gen Z, right, do make very thoughtful decisions on their purchasing investments aligned with their values, right? And so that means we don't have a choice in finance, right? I mean, I'm thrilled about it, but also I do think it's one of those, if you want to play in this next generation of investors, you have to get smart about what they care about and how to address it. I think the second is a greater emphasis on transparency. When we all started this journey a while ago, you did your best in terms of kind of trying to provide information of the impact. I think that bar is being raised by the day. And I think whether it's the SEC, the FDIC, or frankly, your individual investor that's like, can you show me a report on what happened? I think you're going to see continued pessimism if you don't show up with reporting. And so working with partners that can deliver on that in a really easy way is going to be, table stakes in the future. And last, I hypothesize that we're going to see unlikely partnerships. So if all of us get our wish that this becomes the future of investing, not just sustainable investing, I think it's going to take a village. And so I think it's about doing things together and finding unlikely partnerships that say, how do we work together to deliver this? How do we work together to create the norm here? And so I think you'll continue to see some really interesting partnerships develop.
Yeah. The millennial thing is interesting, Gen Z, because they're about to, or already inheriting a lot of us boomers, large S, and there's going to be a lot more money coming into that field. The other forward-looking question is related to the one I just asked, but maybe it's a different take. When we meet again, the three of us in May 2026, in 2 years, what's the conversation you hope to be having about these kinds of impact investing vehicles? Kat, start with you in this one.
Yeah, what a great question. So I'd like to see continued what we call customization. The way we built our platform was to really honor what impact means to you, which is not normal, because I know in my investment portfolio, my advisor was like, okay, well, here are the three things I have, choose one. Not tell me what you care about, Kat, and then let me marry it. And so I'd like to see more and more of that customization, or that ability, right, for us to really honor an investor's needs and values, align all around all the dimensions, right? Not just impact, but of course, what are your return expectations and so forth. And so I'd like to see that, right, continue. But I also would love to see in climate in particular, I'd love us to move from responsiveness, right, to preventive. And so one of the things we're working on with Climate Cash is what we call response and resilience, which is some of your deposits are not just going to go to after a natural disaster, right? And so one of the things that we love and so proud we get to do is we can literally move deposits quickly to places affected by climate change, tornado, wildfires, hurricane. How do you move dollars there into community? Because FEMA doesn't come overnight. And so we're able to do that because of our community partners and our technology. However, we got to do even better. And so where I really want to see us move, and this is what we're starting to do right now, is building more resilient communities. How are we thinking about the affordable housing these deposits are building? How do we make sure that they're resilient? How do we think about the energy utilities? How do we think about the water solutions? And so we're moving from deposits just coming after the fact to really building the future of resilient communities, because we know that natural disasters are coming our way, unfortunately, until we act faster. How can deposits mobilize and really build and be more preventative than just reactive?
Yeah. Wow. Gloria, what's the conversation you hope we'll be having in 2 years?
Yes, I hope that, picking up on something Kat said about partnerships, I really hope that we see more of that, because I do believe that, investing is a spectrum, and there are opportunities all along that spectrum. But from a company perspective that you're investing in, their needs change over time as well. And I would like to see there be more partnerships at the investment level, where it would be more easy for a company to move from, let's say, private equity or venture capital to lending. And I do think there will be opportunities in the future for those kinds of partnerships. Now that more time has passed, and there's companies, we've been around now, like our track record is over 11 years, and so you look at that and go, okay, now there's other companies like us who've been around that long, who now might be more willing to partner on things in the future. So I think we're reaching a point where that's really possible, and I'd like to see that happen.
Okay. Well, I'm committed to an on-time arrival. And again, I'd like to ask you first, both of you, Gloria, and then Kat, in under a minute, what are the takeaways, 1, 2, 3 takeaways that you want viewers of this webinar to have?
One is, if you are a financial advisor, the biggest takeaway is that you really should start getting with your clients and getting to know what's important to them from a values perspective, from what are the causes they care about, and then help them align all of their causes that they care about with their investments, and don't wait for them to ask, because I think it's going to be too late if you wait for them to ask. So I think this absolutely is the time to lean in, as Kat so eloquently put it. And then I would say, second, I really want advisors, investors, whoever's listening, to really dig in and get educated about what options there are out there, and hold us as investment firms accountable to really reporting on our impact that we're having. If we say we're going to have an impact, well, then we ought to be able to prove it, like Kat said. So I think, really push us on that, push us on, are we a real investment? From the investment side, are we disciplined the way we should be? And from an impact perspective, prove it, right?
Yeah.
Those are 2 big things for me.
Kat, you get the last word here.
Oh man, I'll try to do it justice. I would say 3 things to keep in mind. The opportunity here is really growth, retention, and impact. If as a financial, as esteemed financial advisors listening, growth is top of mind for nearly all of my financial advisor friends, right? How do I continue to grow, stay relevant, right? And so these are growth opportunities. These tools that we're talking about today, among others, are growth opportunities to really grow your revenue, grow your client base. Second is retention. Really, as you think about baby boomers and you think about the onset of new clients, how do you retain those conversations within families? How do you retain who you already have who may be moving? And so I think it's a huge retention vehicle. And last is obviously impact. I hope you also share the desire to do something truly meaningful, whatever that means to you. And so I do think that the type of tools we're talking today have meaningful, measurable, transparent impact. So I think that certainly is on the table and incredibly exciting.
Yeah. Well, I lied. I'm actually getting the last word here, but thank you so much. Do we have a slide, I think, with some contact information for you both? If someone could put that up there. I think anyway, that is a wrap for today. Thank you to Catherine Berman and Gloria Nealon for a great conversation. I learned a lot. and I'm hoping you did too. The reminder that the recording will be emailed to all participants who registered. So thank you all so much for joining us today, and have a great rest of the week.
Thank you, Joel.